Hi everyone, this is Mrs. V Chen and welcome to my Form 5 Accounting Lesson 2. And today is 12th February of 2020. Okay, so today's lesson we have System 2, and which is fixed capital accounts plus current accounts. Remember, in System 1, we have this fluctuating, and fluctuating means always changing, right? Because after you have post everything into the capital account, and then when you look at the closing balance here, okay, it is very often not possible to be equal to the amounts I have introduced it, which is 10,000, and the amounts introduced by Ensign 20,000, right? So that's why we call it fluctuating. Okay, what is opposite to fluctuating? And that will be System 2, which is fixed. So if we want the amount to be fixed to the capital introduced, therefore we need another account, which is the current account. Okay, all right, let me show you the transactions and the double entries. Okay, so step number 1, same as before. To set up partnership, partners have to bring resources into the business. So therefore we have this double entry, debit bank and credit capital. So there is no difference between System 1 and System 2 for step number 1. Okay, however, when you look at number 2, salary to partners. So why we pay salary to partners? Because Ensign works so hard, so we have to compensate to Ensign. So therefore the business pay, so that will be debit profit and loss appropriation account. Since we want capital account to be fixed, we don't bother capital account. This time we need current account for recording salary to partners. All right, so let us make comparison again and show you the previous one. So you look at this. This is the previous example. So debit profit and loss appropriation account for salary to partner, which is same, but however in System 1 we use capital account. But since we are doing System 2, so we don't bother capital account, and then we use current account instead. All right. Okay, so next we have interest on capital. So therefore debit profit and loss appropriation account means the firm has to pay, and then who will earn this? The partners will earn this. Again, since we don't want to bother the capital account, we use current account. All right. So you can see these two double entries are exactly the same. Okay, and then the next thing, so we have interest on drawings. Okay, so this time the partner has to pay after drawings on interest, so therefore we debit current account instead of capital account, and credit profit and loss appropriation account. So this time the firm will receive interest on drawings from partner. Are you okay? All right. Okay, now we come to number 5. So according to business entity concept, whenever owners take away something from the business, we need to record this as drawings. So debit drawings, same as before. Okay, the owner can draw cash. The owner can draw money in the bank of the business. Oh, do you remember this? Credit purchases means what? Means the partners or the owners take away what? Take away inventory. Now this is a special double entry. Oh, credit motor vehicle. This time the owner takes away motor vehicle of the business. All right, but it doesn't matter. Okay, in partnership, so drawings will not be shown in the statement of financial position, so that we have another step. We need to close drawings account into, because this is System 2. We don't want to bother capital account, so therefore we close this to the current account. All right, so the double entry would be debit current account and credit drawing. So debit drawings and credit drawings, so no more, because we are not going to show this in the partnerships statement of financial position. Okay, and finally, so we may have share of loss and share of profits. All right, same as before. If we have a debit balance in the profit and loss account, and debit balance means debit side bigger, right? And debit side is a negative thing. So when we have negative thing bigger than positive thing, so we have share of loss. So for this share of loss, it is not a good thing to the partners. So therefore we debit current account. Why current? Again, we want capital to be fixed. And credit profit and loss appropriation account in order to close the profit and loss appropriation account. Okay? All right, so finally, the opposites. So we may have credit balance in the profit and loss appropriation account. And credit balance means credit side is bigger and credit side is good thing. So therefore we have share of profits. As for share profits, so partners are happy about that, so they will credit their current accounts and now close the profit and loss account by debiting profit and loss appropriation account. Are you okay? So after all these double entries under system 2, let me show you the effects of capital accounts and current account. Now this is system 2, fixed capital. Okay, why fixed? Here, Anson and Vichen, we contribute 20,000 and 10,000. All right. So therefore, all three things like salary to partners, interest on capital, interest on drawings, we don't bother capital account, right? So therefore, when we close it, we have the same amounts, right? So that's why we call this fixed. Fixed to how much? Fixed to the amounts that the partners being introduced with at the very beginning. All right, so that's why we call this system 2, which is fixed capital account. Therefore, we need the help of current account. So what do we have in the current account? Now this time we have salary to partners. We have interest on capital, so this is positive here on credit side. That means the partners will earn salary, will earn interest on capital. And if this is share of profit, it is also a good thing to the partner. So on credit side, right? So the opposite will be drawings, will be interest on drawings charged the partners, and share of loss a bad thing, and therefore you close this as closing balance in the current account. All right, so don't worry about too much about this, because later on I will show you, maybe in lesson 3, show you about the statement of financial position of a partnership. Okay, so therefore finally, so this is the profit and loss appropriation account. So actually, so the extra part net profit same as before, and then since the partnership is going to earn this interest on drawing, so this is the positive side, but this time it is not the capital account makes you credit. However, it is the current account. So this is the name of the account and this is the description. All right, so the opposite side, we have current accounts that do the posting. Right, current account, so we have salary, this is a pair. And then current accounts here, interest on capital. All right, and finally, if there is profits, that means this is a credit balance, and credit balance being bigger than debit side, so we have share of profit like this. Are you okay? So this is the system 2, fixed capital account and current account. All right, now we come to comparison. Which system is better? Okay, let's go back to system 1 here. The closing balances here must not be equal to the amount I have introduced, which is 10,000, and amount being introduced by Anson, which is 20,000. Is that right? So however, what about if I draw more than 10,000? I don't think this is healthy to the partnership. So therefore, this is very important to serve as an indicator, not allow partners to draw more than the money being introduced. Therefore, we have system 2. Okay, so in system 2, this is the closing balance. So we can always know that how much being introduced by all partners, because all transactions being entered into the current accounts. All right, as not to allow partners to draw more than 10,000 for me, to draw more than 20,000 for Anson. Okay, so therefore you have this related DSE question in 2012, question number 7B, saying, explain one advantage of maintaining both current accounts and capital accounts in a partnership. So whenever you have current accounts, that means the capital accounts must be fixed, and which is system 2. All right. Okay, so the answer is here. So the advantages of system 2. So what is important? The initial investments made by the partners. Okay, this is important as to give indicator and signal and warning as not to allow the partners to draw more money than that. So to make the financial position more healthy to the partnership. Okay, all right, so that's it. Thanks for watching my video. And actually learning accounting is fun. And then I will see you next time. Bye bye.